the main stage and some other talks in Bitcoin for Corporations symposium. So in all of those, he tried to explain the idea of digital money. So what I will try is I will try to tell you guys what I personally understood from the digital money idea, and let's go into this digital money kind of a thing. So as usual, everything starts with Bitcoin as digital capital. So because Bitcoin is digital capital and it's a pristine collateral, I think Amol did a phenomenal session on explaining why Bitcoin is pristine collateral. He compared it with real estate. I watched half of the session where he was talking about mortgage debt and all, how illiquid is it, and the process of creating a loan backed by real estate. So it's a hard process to go through it. Now, when it comes to Bitcoin, because Bitcoin is digital capital and verifiable, transparent, because of that, creating digital credit is much more easier on on a on an on a network like Bitcoin, when you compare it with real estate or consumer loans or vehicle loans. It makes much more sense to have digital capital Bitcoin as a base layer, and on top of that you create digital credit. So it is much more transparent, much more yield giving instrument can be built on that. Also, Saylor talked about this point, um, at first he thought that digital credit is we are giving too much yield to the investors, but later he figured out that this is not a bug. This is this is the way. For example, he talked about in the US you get 4% in the bank account. In the EU you get 2 to 3%. In Japan you get 0 to 1%. In Switzerland you get 0%. And that's the reason why you need digital credit. And currently the issuers of digital credit, by when I say digital credit, I mean the preferred stocks which are being issued by Strategy, Metaplanet, Strive, throughout US, Japan, maybe STRE was launched in Europe. So let's see how this digital credit grows. So Saylor talked about creating digital credit, and the only reason strategy exists is to transform digital capital into digital credit. So the only work that strategy will do is this. Here on the left hand side they have digital capital, and on the right hand side they have digital credit. So when they create this digital credit, they strip the volatility, they strip the risk by over collateralizing their products by 4 to 10 times, 10 times much more over collateralized. The credits which we have in the market right now are 1 times over collateralized, or maybe 80 times or 80% collateralized. You also know these banks, currently banking reserve ratio in the US is 0%. So literally banks can have unlimited issuing of credit. Now, when he talks about digital credit, he goes back into 1900s, 1800s, and talks about how things looked when gold was there. Um, so when gold was there, uh, there was also gold backed credit, and things were working pretty smooth. And the people who issued gold backed credit, they they tend to be among the richest people out there in the world. So who were issuing gold backed credit? Basically the Rothschilds. The banking's whole of the banking was started by the Rothschilds, and they started issuing gold backed credit. They started issuing banknotes. How the settlement looked in gold era was, there were few banks who had gold with them, and on that gold, let's say you are a trader or you are a businessman, and now you are going from like France to England. In France, you have a bank, let's say Bank A, and you deposit your gold in that Bank A, and you collect a note issued by that Bank A that this guy has deposited 100 tons of gold, and when you reach in England, you want that 100 tons of gold back. And this was basically the currency or credit note which these banks created. The problem started to arise when these bankers realized that at a point in time, not a lot amount of people are coming to redeem that credit note. And because they saw this, I think they started gaming the system, or this is how fractional reserve banking came into existence. So what I think personally is, because Bitcoin is transparent, uh, we can see, even though strategy has not revealed the address public where they hold their bitcoins, but still there are intelligence on chain analysts or intelligence companies which work on chain, and they have figured out that like 95 to 97% they have marked the bitcoins which strategy has. So out of 670,000 bitcoins which they have, almost 97 or 95%, I am not sure what the exact number is, but they have marked the total number of bitcoins which they have. So because of the transparent nature of Bitcoin, I hope that we will not be in the situation we came into, basically the fractional reserve era. I somewhat believe that there will be fractionally reserve bank in Bitcoin standard as well, but you will have the option to be a part of that fractional reserve bank, or to be a part of an over collateralized bank, or to be a part of like 1:1 collateralized bank. So basically, the risk or the yield will be like this. A fractionally reserve bank will be giving you much higher yield when compared to 1:1 collateralized bank, and when compared to 4:1 over collateralized bank. So compare it to the products of strategy like STRF and STRD. So the yield on STRD is nearly 12.5%, but the yield on STRF is nearly 9%. So this difference between this is like the credit spread. This is the spread between the two products of strategy. 12 point, like basically 3.5% of credit spread. So STRF, if I'm not wrong, it's around 6 times over collateralized, and when it comes to STRD, it's 4 times over collateralized. So and also STRD is non-cumulative, STRF is cumulative. So people are pricing that in this credit spread, and this is the reason why STRD is yielding more than STRF. So Saylor talked about that maybe on the digital credit era or credit on Bitcoin will be like free market yield curve. Like STRF is long duration. Excuse me for the handwriting and graphs, but yeah. So STRF is long duration credit. STRC is short duration credit. So you can compare STRF with like 10-year US treasuries and STRC with a 1 month T bill. So if you can see, STRF yields 9%, STRC yields around 11% if I'm not wrong. STRD is much higher. STRD is here, or STRD. Then there are much more some other products as well, STRK, STRE. So I will not talk about that, but what Saylor is saying that he's trying, or digital credit, basically the transparent credit, will be the free market yield curve. And what is free market yield curve? The current yield curve which you see is managed by Fed or their own respective central banks. For example, if you invest in 1 month US Treasury, you will get some basis points of like interest coupon or something. And when you invest in 10-year US Treasury bills, then you will get 4%. Don't take me on numbers, but this is how it will work, or 5% maybe. And how are these percentages set? These percentages are set based on Federal Reserve's like Federal Funds Rate, FFR. In case of India, it is based on repo rate. So when in case of digital credit, the market itself tries to figure out, tries to price things like how to value these products. So this will be the free market yield curve based on digital capital. Now coming to he also talked about trust. Like this is my own thing where I have drawn some diagram based on Saylor's trust scale, where he talks about if you trust absolutely nobody, then you buy Bitcoin, and you have long time horizon, then you buy Bitcoin. So zero trust and you have longer time horizon, 4 5 years, then you buy Bitcoin. Let's say you trust strategy to, like, some you trust them somewhat and you don't have a long time horizon, then you buy their preferred products. So like before I think this would be a good time to show you guys about the recent STRC versus Bitcoin's chart. Just a minute. So this is how STRC looks like, and let's compare it with Bitcoin. So if you see, In case of STRC, from the starting point when STRC launched, uh, you have you have earned like 11% or 12%, and when you compare it with Bitcoin is down 25%. So this is where your time horizon kicks in. So if you have a short time horizon, it might be better to buy digital credit, and you also trust, like semi trust strategy, semi trust Bitcoin. Also, he is trying to make now like dividend reserves, where now yesterday he added around 750 million of US dollars to increase that dividend reserve uh, to 32 months. So even if his stock is not above 1 times MNAV, he will be able to pay dividends for 32 months as of now. So if you trust all of these, if you have semi trust also, it's a good idea to buy prefs, and you have comparatively a short time horizon. Now, coming back to our screen, if you trust that Bitcoin will be giving like a 30% CAGR in 20 years or in 10 years, and uh, the prefs will keep continue to grow in number, the extra 20% will be going to MSTR stock in the long term. So if you think that this will be the scenario, then you buy MSTR. Also, when you buy MSTR, you are trusting strategy like 100% that they will do everything right. Um, One more thing which I would like to talk about, which I personally didn't hope that they will be so quick in this direction. I think Amol was always telling about this optionality part, optionality of having 6,70,000 bitcoins. Maybe you guys might have came across to some videos of Saylor or the CEO Fong Lee talking about doing some building some products for banks. So they will not be a bank, but as you if you can see Sailor's X, or let me show you um, Sailor's X profile. He has been posting about meeting bankers. Personally, I didn't hoped about that this will be. I thought that this will be the end, but it's like this tweet gets the bank, and they have started meeting banks where they might figure out some business models where they will give their bitcoins to banks, and banks will create some digital credit on top of that, and from that maybe he might be generating some yield. Also, risks are also there when these kinds of transactions will happen. What are the risks? So basically, rehypothecation risk uh, will start when these things kick off. So you have to consider that as well when you invest in MSTR. So
Can
yeah,
can you
if
explain
yeah.
how rehypothecation will happen? Because everything will be transparent in Bitcoin. Everyone knows the addresses or means how many Bitcoins are being given, or how this rehypothecate means it can happen. Can you just explain it?
Yeah, I'm also not too like I'm just speculating that this might happen because recently strategy has moved some part of their Bitcoin from some part of the Bitcoin from Fidelity. So it's kind of let me draw this. So strategy has a custodian named as Fidelity. So they have Bitcoins in Fidelity, and this was a separate kind of uh, like separate kind of account, let's say. And what they have recently done, so this is only Fidelity and strategy. Now, what they have done recently, I am not sure about that they have done, but some of the on-chain analysts out there, they said that strategy have moved some bitcoins from here to here. So what is this? This is also uh, Fidelity's Fidelity is basically multi custody account or something, but here the custody is mixed. So Fidelity is also custodying for, let's say, strategy, let's say Strive, let's say they are on FBTC. So here, what they have done strategy, instead of having their own separate account, they have moved their bitcoins to this like multi custody structure where bitcoins are commonly held by Fidelity for some of the like public entities. So maybe in future rehypothecation can happen via this. Strategy has, for example, strategy moves 10,000 bitcoins here, and total here they hold is maybe in this multisig account they hold maybe 100k BTC, and let's say FBTC holders sell out there for a Bitcoin ETFs, they redeem their Bitcoins and go to like self custody. Now, essentially, here this is how some things can happen where uh, no one says that we have sold Bitcoin, but in this we might have the number of Bitcoins go from 100k to 90k, but in the books, if you go in the books of these companies, you will see 100k Bitcoins, but in multisig they have 90k Bitcoins. So this is one concern which might happen in the future, but as of now, uh, there is only a small part which is being transferred. It might be a regular. So strategy also does this in regular intervals. So there is a speculation that this may happen. I'm not sure this will happen. We'll have to see how these things figure out or in the future. Uh, so this is how it's very complicated to understand for me as well, like how rehypothecation might happen. But yeah, when banks involve, the transparency will might go from like things are very transparent right now, but when banks come to decrease volatility, they might decrease transparency as well. And if transparency decreases, then there might be a case where volatility also decreases, because in their books they can show we have 100,000 bitcoins, and like they report every 3 months, and in that 3 months they might be doing some opaque transactions, which I'm sure on-chain analysts will figure out, but this might be the way which can happen. I'm also not 100% not sure like how will this happen. So this is my rough guess that this might be happening. Maybe like if Amol or someone has an idea like how these structures work. I'm not sure if anyone has idea because the things are very new, and like every day there is a new thing happening in this space. So we'll have to see how markets evolve and how products evolve going forward.
Digant, I had a question on this. You were saying that MicroStrategy team is going to banks, and then you
Yeah,
shared one of the possibilities is they are basically offloading their Bitcoin to banks, and then banks could
yeah,
offer similar kind of credit the that MicroStrategy themselves are offering, which is like something like STR C and something like that. But
yeah,
like in Dubai, I think this is something that you're also discussing is that they have plans of offering the next layer on top of digital credit and for digital money. And for that, they need partnership with banks. So why is that
yeah.
not a possibility that they are talking to all these banks for their digital money
Yeah.
offerings? Yeah.
So,
Yeah.
so
So
yeah,
how
good
will that
question.
work out with Morgan Stanley or some of these banks?
Yeah, good question. I think let's hope that this is the thing where strategy team is talking about this part, digital money, and not about the part which I explained before. Uh, but yeah, this is also a possibility. Don't the basic rule when you invest in equities is be skeptic of what a management can do. So this is I am being skeptic. But yeah, as Saurabh talked about, they might be meeting to tell them about digital money. I have not come to the part where I have explained this digital money, but yeah, I will start explaining digital money right now. If no further questions, we can dive into digital money. So, okay, great. So, what is digital money?
Jigat, I had one question regarding
Yeah,
digital
yeah,
credit. So, one
yeah.
thing is that it is when we go to bank, we offer some collateral. Bank gives us credit. That is normal traditional credit. So, in digital credit, what is the what is the flow here? What happens? Like strategy goes to banks, keep Bitcoin as collateral, and then take loan. Is that a digital credit? Can we call that as a digital credit?
So digital credit issuer is strategy. They don't need to go to any bank to do digital credit as of now. But going forward, if they design some products, I'm not sure if they can design. But as of now, digital credit is their preferred products and their convertible bonds, which is over collateralized by 4 to 80 times. Like convertible bond, if you go on strategy.com/credit, you can see convertible bond which is due in 2027. It is collateralized by 70 times, I think. So as of now, digital credit is issued by a Bitcoin treasury company, in our case strategy, and they don't need any bank to issue digital credit. When it comes to digital money, they will need to do partnerships.
Okay, so why are they calling it digital credit? Because it is just like raising funds from market and buying Bitcoin with it. There are different ways of doing that. One is through common stock, other is through preferred or some bond type structure. So that products are already there. There is nothing different. Why are they calling it digital credit?
Uh, Good question, because even preferred stocks come into equity side and not into like debt like kind of a thing. But how Saylor is explaining, he compares a preferred stock to a bond, and when he compares it, he says that if let's say if strategy raises a bond, a plain bond, a straight bond, uh, which has a coupon of 5%, but at the end of 5 years he needs to return that principal amount back to the investor, uh, where in case of preferred stocks, uh, there is no need to return the principal. This is how they have structured. He calls it perpetual preferred stock. So the perpetual preferred stock means it is perpetual in nature, and that's why you don't need to return the original capital back to the investors. And why are they calling it as a digital credit instrument? Is because uh, they they want the, how I can like say it is, they want
I
first
will
10%. Yeah.
I will ask it reframe the question. Like, if suppose if some other company, Microsoft or some Nvidia, they are issuing preferreds or they are issuing bonds, similar to MicroStrategy. So, how can we call them also digital credit? If they are
Yeah,
something different, then why is
if it is
we?
if it
Yeah,
is
yeah,
based
yeah.
on Bitcoin, then we can call it digital credit. So, digital credit is a term coined by Michael Saylor himself, which if you have gone through the book of Treasury of Michael Saylor, he talks about digital credit, where digital is nothing but because it is backed by Bitcoin, as and he calls Bitcoin as digital capital, and on top of that, because he doesn't need to return that principal amount to the investor, uh, and because of this reason he calls this thing as digital credit. Instead of coupons he is giving dividends, and the extra return of Bitcoin on top of the dividend goes to the MSTR common stock. So this is how he is uh, like explaining stuffs to different kinds of investors. So because the preferred product is much more closer to a bond or a fixed income kind of a thing, he calls it credit. But structurally, if like theoretically, if you ask me, is preferred stock a credit instrument? I will say no. But uh, in current world, there is no perpetual preferred stock out there in the market in the US. So Saylor talked about this thing in one of his talks, where he said that when we came out with preferred stock, he said that there was a preferred market in the US, but that market was too small, and that's the reason why the largest preferred stock issuer in the US is now Strategy. There is no company other than Strategy who is issuing preferred stock at this scale. So when I think because the things have scaled to such a large level, uh, he is changing the definition of this from a preferred stock to like, he's not literally changing, he's calling it just as digital credit, but legally and like theoretically you can't say it as um, credit.
Yeah, yeah. Because it confuses things like in terms of explaining it brings a lot of confusion because in traditional credit we as we are giving collateral and bank or some institution is giving us dollars or rupees whatever currency it is, that is a traditional credit. If we are calling something digital credit, which is backed by Bitcoin, then it's MicroStrategy or someone is giving Bitcoin to them as a collateral security. which may be 110% or 115% over collateralized. They take that loan from the bank, and bank is happy to give the loan because they are over collateralized, and they can give the loan at a much cheaper rate. Uh, and maybe with that loan strategy can buy Bitcoin or something that maybe can be a digital credit flow. But these products are already existing products, and MicroStrategy is issuing common stock. They are issuing bond type structure preferreds, and they are calling it is a digital credit. Like it is confusing things, but that is okay. Like
One
we'll
thing
clarity.
which I would like to add on here. I got your point where this is creating confusion, but if you see traditional products, they are not as liquid as the products which are designed by strategy. So in one of the slides in the talk, he talks about average daily trading volume of a convertible bond. Basically, convertible bond can't be bought by a retail individual in the US. It's illegal to buy a convertible bond. Now, come to preferred stock. So, before coming to preferred stock, a convertible bond is traded on OTC. Now, what is OTC? OTC is basically there will be group of banks who will trade like with one another, and there will be high bid-ask spreads. So, higher bid-ask spreads, that means market is inefficient. So, for the people who don't know what are bid-ask spreads are basically, let's say there's a stock trading in the market which is priced at 100, and the ask price is 100.01, and the bid price is 99.99. So this is like highly efficient market. But if the ask price is 105 and bid price is 95, this is highly inefficient. So, in case of convertible bonds, the products are highly inefficient because they trade on OTC, and there are 12 bankers who are trading with one another. When it came to preferred stock, it became slightly more efficient. In case of strategy, it became 100 times 130 times much more liquid than a traditional preferred stock which is out there in the US. So average trading volume of preferred stock issued by some company in the US is 1 million, but if you see the trading volume of STRC, it's 130 million. In case of all other preferred, it's 30 million. So basically, I think this might be the reason he coined this term digital credit, because it's much more transparent, much more liquid, and much more fair, where a public or a retail can get access to. When it comes when you talk about traditional credit products, only bankers are making money or making fees out of it. But because of these products, they are much more transparent than whatever else is out in the market. This might be one of the reason.
Okay, okay, thank you.
Yeah. Okay. So now coming back to our idea, or Saylor's idea of digital money. So basically, any bank has these two things: assets and liabilities. Liabilities is basically what the bank owes to a particular individual or a particular entity. So, Saylor talked about this idea where a bank does this thing. Now, let's say you get $100. Uh, it's not working. $100 in deposit. You get $100 in deposit by customers, and this is your liability towards your customer to give them back this $100 whenever they require. Now, what do you do with $100 to run your bank is, uh, in case of digital money, you put 80%, that means $80 in STRC, and you get 10% yield on it. And rest 20% you keep in currency, that is USD, and extra 10% you make some reserve kind of a thing to, like, to make this digital money account zero, at a volatility of 0%. When you achieve this, because if you go to STRC is volatile. It's volatile. Let me check, like, how much volatile it is as of now. I think it's 6-7% volatile. 8
Was the last
sorry for
10% reserves? That 80 plus 20 plus 10 is 110%. So what are the last
yeah.
10%?
This 10% comes from your own pocket. This is not a fund raised by or raised from your customers. It's your own thing to, like, decrease this volatility of this product to 0%.
Okay.
Did you get that?
No. But yeah, continue. I'll probably get it like over the
No, no.
over the.
So let me just explain. Let's say, Saurabh, this is your bank, and you raised $100 from us. And what you did, you told us that I will give you 8%, and no one is giving you 8% out there in the market, but I will give you 8%. Now, how I will give you 8% is, I will invest $80 of this $100 in STRC. Rest $20 will be in currency, maybe where I will get 4-5% on this $20, and the 10% is your own capital. So this is not the capital raised from your customers. This is your $10 which you are putting from your own pocket into this asset side of things. This should be so when you study banking business model, this is termed as reserves, but in other case, always in balance sheet, A equals L plus E. So this is equity in all other scenario, but
If
in
you are
case of bank, yeah.
Digant, if you are sharing your notes, we can't see the notes. Just letting you
Oh,
know.
I'm sorry.
But yeah, I
Sorry
could
for that.
understand it. I could understand what you shared so far.
Yeah. So what I was trying to explain, the reserves will be put by you from your own pocket. So extra $10 you are putting in because you want to create this digital money account 0% volatile. You want to strip off that last 8-9% volatility from STRC as well. And to achieve this, what you have done, you have put 20% in currency and 10% in reserves. And as you know, from fractional reserve banking and stuff, like, there is a very less chance that more than 30% of people come to you at once and ask their money. So this is how you create a digital money account. uh, this same thing was talked by Abhay when I met him in Goa. He said that I am going to I'm going to make a digital account where I will back that account with STRC, and I will give them 8% or 9% interest, and I will figure some things out, but yeah, this is the product which I am working on right now. I asked him to join the session, but I think he might be asleep in the ways. But yeah, this was his thing. It was like fascinating for me because I was thinking about this idea, and after Abhay told me that, yeah, this could be done, I was thinking and thinking. I thought that, yeah, this could be done, but what if STRC goes down? And which happened when Bitcoin went from 120k, 126k to 83, 84k. STRC went from nearly 100 to, I'm not sure, 85, 90. So how will Abhay handle this kind of volatility in a digital money bank account? Because people will see their $100 gone from 100 to 85, so they will not be happy anymore. Even if they get 9-10% of like yield in their bank account or interest in their bank account. So, and here Sailor comes and talks about this digital money bank account, uh, about this concept, and he talks about how to strip off that last 8-9% of volatility and create absolutely 0% volatile product. And when he talks about
There's
creating
a
digital money, yeah,
there's a chance that the reserves might not be sufficient, but you are betting on the fact that not everyone will draw all the money at the same time. So
yeah.
10% is a is an okay number.
Also,
10% seems like a reasonable number.
Also, you have Saurabh 20% of currency as well. So even if people go, like more people demand you like you give currency part, you don't give the, like you don't sell STRC, you sell US dollars, or you just give them US dollars.
Okay. Yeah.
Yeah, this will also decrease your liability also from 100 to 90, from 90 to 80, like as and when this thing keeps happening. So yeah,
What will be
this is
the
yeah.
Yeah, sorry. What will the users get? Like if they pay $100 to have the digital money, what will he get in return? Like will it be share or some kind of instrument or some kind of a
This is
token?
a this is a bank account where he will get $8 interest per annum in his bank account. So this digital money is a concept where I will come to these points. So digital money coin is also there. Digital money fund also can be made, and the digital money account is also a possibility of digital money. So this depends. It depends on what kind of a person. So digital money fund, a hedge fund manager can design a fund like this, where like he promises 8% and keeps extra, like STRC is yielding, I think like 11% or something, or he keeps this 20% interest part as his income, and he gives away um, all of the dividend or all of the interest which he received on STRC. So this might be his the business model for digital money fund. um, and when you regulate that product, get the permission from your regulator and design a bank account, that will be digital money account. And digital money coin is basically for example USDT is a coin where you don't get anything on top of your USDT. But now think of USDT as, let's say you have $100 of USDT and there's a coin, for example. So I don't want to, I mean, there is a coin, there is a project already which is working right now on this digital money concept called I'm not sure if I should take a name. So let's say X USDX coin. So what that coin is doing, that coin is giving me 10% holding, 10% in USD just for holding that coin. And how are they giving me that coin 10%? Basically they have, let's say I deposit USDT and get that USDX coin from that issuer of USDX. $100 collected for from me. What he does, he invests 80 in STRC, keeps 20 in currency, and he adds extra 10% from his own pocket. And this is how he gives me 8% on uh, like stable coin, which is based on US dollar. And he keeps extra, like he can give me 7% and keep 1% as his margin. So yeah, the products have started to like come out on this digital money concept as well. To
This
your
is a
question, Amol, did I answer your question? What
yeah.
a person
Here
is getting?
again the name. Here again the name is like confusing. It is like they are telling it to the digital money. In money, we do not expect to get any return. Like if we have US dollar, we do not expect to. If I am using it as money, I do not expect to get any return on it. If I am using gold, if there is no
Uh,
expectation on return on gold, if there is some promises given, like of the return which you get on that particular instrument, then it is basically a security. Like how can we call it digital money? So that again the terminology, the digital money is confusing.
it is not like security or something. Compare digital money to bank account. This concept is comparable to bank account. So when you keep your money in a bank account, you get some interest. So this product is comparable to that. It is not security. To your point, I think you are right. When it's money, we don't expect an interest or something on top of that. So yeah, but this is what it is. This is how he explained. So coming back to digital money, because you keep 20% in currency and 10% in reserves, you have stripped away the last 8-9% of volatility from STRC, or maybe 19%. Last 30-day volatility of STRC is 19%, but that is not a good number to have because of the recent drawdown. But yeah, I mean, or let's say let's take 20% also. The 20% volatility will be taken care by the currency part, which we invested in 20%. Or let's say we don't invest 20%, we invest 30% in currency and 70% in STRC. Or we increase reserve part, we increase from 10% to 20% or 30%. So by playing with on asset side, we can strip off the volatility of the STRC product and bring it down to 0% volatility, which is 100%, which is like 1 is to or like 120 or 130% over collateralized to dollar, and which yields 8% because you have not invested that dollars in US treasuries, you have invested that dollar in digital credit, which is STRC, and because of that you are able to give 8% yield. And if you calculate Sharpe ratio, what is Sharpe ratio? What return you are giving minus risk free rate divided by volatility. So you are giving 8% on your bank account, and the risk free rate is 4%. 8 minus 4, 4 divided by 0 goes, Sharpe ratio goes to infinity. So when this thing happens, now compare it with the the products out there in US, EU, Switzerland, Japan, and developed nations. They give from 0 to 4 5%. So when you give extra 300 basis points more, obviously more capital will come into your nation, will come into your bank. And this is what Saylor talked about. The biggest idea is basically digital money. You allow your banks to create a digital money bank account where this structure is uh, done roughly. This will be the structure, asset liability structure of balance sheet. and the market for digital money is 20 trillion. The the big idea which he explained to sovereign wealth fund, banks, basically the head of the states, is invest your sovereign wealth fund in digital capital, that is Bitcoin. Invest in the credit products which are based on Bitcoin, like strategies products, which give 400 to 500 basis points more than what is out there in the market. So basically, if you invest in credit markets, you will get at max 4-5%, but in case of digital credit, you will be getting 9-10%. And invest in digital equity if you trust them and if you have long time horizon. Generally, sovereign wealth fund have long time horizon because it's a nation has a long time horizon. Bigger idea is allow your banks to self custody Bitcoin, and if banks are allowed to do self custody, then he said that there might be a case where Bitcoiners will start depositing their Bitcoins in your bank. And so there were cases where some Bitcoiners gave away their self custody Bitcoin and they started buying ETFs. And with ETFs, they started selling options, covered calls, or put strategies where they could generate some yield on top of Bitcoin. And these kinds of products can be built as a bigger idea. And at last, he talked about digital money as a biggest idea. To the concern of Amol, I think it creates difficult to understand at first glance, but whatever he is explaining, that is doable from what I can see. This digital money bank account can be created. I mean, it's nothing wrong in here. Uh, in a way, it is much more over collateralized than what a traditional bank gives. It is giving you much more return as well, or much more yield as well. So yeah, this was it. This was about digital money and all. Jatin, you
I
can
had
stop recording.
one
Uh,
more question
the
regarding digital. Hello.
Yeah.
I had one more question regarding digital money. So when we say digital money, we most probably will be using it for payments, like we are presently using USDT for making transactions, making payments. So if a digital money account is created, how will I use that to make payments, make payments with it?
So there's a product out there in the market which I was studying. Uh, Jatin, have you stopped
It is a
recording?
token.
Because yeah, I
Is
will
it?
explain, but I don't
Uh,
want to talk about that product out there in public. Jatin, let me
is it?
know when you stopped recording.
Yeah.
The question is right. Basically, how will you do transactions the if you have this digital money account? If you have your money in digital money account, the question is